Okay, welcome everybody to our town hall. This is what's new with Social Security, 8 topics that we want to watch for in 2025. So, what are the topics that we'll be talking about today? First and foremost, we'll definitely cover cost of living adjustments. I know that this is a number that a lot of retirees look forward to because it's almost like a pay increase for your Social Security benefits. We'll also cover some other numbers like 2025 earnings test, Social Security taxes, some Medicare premium numbers, and also some important Medicare dates to be watching for in 2025. We'll also talk about Social Security trust funding and maybe some proposals for reform because there's been a lot of buzz about Social Security and what's going to happen with that in the future. We'll also talk on updates to Social Security claiming strategies. And lastly, the WEP, which is the windfall elimination provisions in GPO, has been recently repealed. And I'll talk a little bit about who that affects and what that all entails. So first and foremost, the cost of living adjustment. So if you're currently on Social Security, you know that every single year there is a cost of living adjustment, which we call COLA. And this is an increase to your benefit based off of inflation rates in the previous 12 months. So what does that look like for 2025? They announced that in 2025, the COLA adjustment will be around 2.5%. And this is going to be active for January 2025. So you should have already seen an increase to your Social Security benefits. This is just an example of what that COLA amount equates to based off of your benefit amount. So you can do the math. If you have an $800 benefit, a 2.5% increase will equate to about $20. So your new benefit amount is $820 and so on and so forth. So you can see if you have a higher current benefit amount, the 2.5% adjustment will result in a much higher benefit amount. Do keep in mind though, that the COLA could be absorbed by Medicare premium increases, okay? So this COLA does not factor in the additional Medicare premium increases. That is a completely separate line item. When we look at COLA in perspective, dating back to about 1990, you can see that it kind of fluctuates anywhere from about 0% all the way up to about 8.7%. Now, the highest increase that we have experienced was back in 2023. And if you remember, we were in a global pandemic in that time frame, and inflation was running really high in 2022. Therefore, in 2023, the COLA adjustment was a very sizable 8.7%. We had a lot of clients who were Social Security beneficiaries very excited about their pay increase. But, to put it back into perspective, historically, it's probably been closer to about 2.6%. And we expect that it should be around 2.4 to about 2.5% going forward. Unfortunately, we probably won't see that huge kick up to 8.7 because we have inflation under control pretty well. So that's just to give you some perspective into COLA in history. What are some other numbers as it relates to Social Security? Well, there is something called an earnings test, and this is going to apply to those of you who are still working and maybe you're considering filing for Social Security. So listen up if this is you. What is the earnings test? So the earning test applies to those who are under FRA, which is full retirement age. And according to Social Security definition, full retirement age is around 67 years old. It's actually 66 and some odd months if you were born before 1960. But for the purposes of this conversation and this example, I'm going to assume that you were born after 1960 and your full retirement age is 67, okay? So someone who is under the age of 67, currently receiving benefits or thinking about applying for benefits, but they are still working. So if you fall under this criteria, the Social Security Administration will actually withhold a portion of your benefits if you make too much money. So in 2025, that threshold is $23,400. This is up from last year, which was around $22,000. What happens is if you're still working, you're claiming Social Security benefits, you're under the age of 67, for every dollar that you make above $23,400, they will withhold, for every $2 that you make, they will withhold $1 in your benefits. So why do they do this? Well, they don't really want people to start claiming Social Security early, continue to earn an income, and not have any sort of consequences with that. So keep in mind that when they withhold that benefit, it's not that it's lost. It's not that it's gone forever. They just want to make sure that you're really waiting until the full retirement age, because that's when you get your full benefit to claim Social Security. Where I have seen this bite some of my clients in the butt is, they say, well, I want to go on semi-retirement at 65. And I'm going to start Social Security at 65 just so that I can have a paycheck. A couple of years down the road, they're like, well, I'm kind of feeling bored and maybe I'll go back and get a part-time job and, start making in some income. Well, because they're under the age of 67 and they started claiming Social Security with their income, if it's above the $23,400, all of a sudden they're not going to be getting 100% of those benefits that they claimed. They're only going to get 50% of it. So be really careful when you're considering claiming Social Security if you're already on it and what that taxable income might look like for you. They do become a little bit more generous with these rules. If, let's say, you're turning 67 this year and you're already on Social Security, well, instead of withholding $1 for every $2, they're just going to withhold $1 for every $3 leading up to the month that you turn 67. So all of this is a lot of information. Just talk to your financial planner. If you're under that full retirement age and you're on benefits or you're thinking about claiming early benefits, it's really worthwhile to talk with your planner to see what your financial situation is, because you don't want your benefits to be withheld. The other number to pay attention to for Social Security is Social Security taxes, and this is going to be broken out into two different parts. The first thing that we'll talk about is the maximum earnings that are subject to Social Security. So again, this is still for those who are in their earning years. They're not quite claiming Social Security yet, but they still have to pay into that Social Security system via Social Security tax. So in 2025, they increased the maximum earnings to $176,100, and this is up from about $168,000 last year. What this means is if you are earning $250,000 at your work, only $176,000 of it is subject to Social Security tax. So if you earn less than $176,000, then all of your wages are subject to Social Security tax. But if you earn more than that, then only a portion of that is subject to Social Security tax. The other equation to the taxes is going to be payroll tax. So right now, if you're still working, 6.2% of your paycheck goes towards Social Security, and then the other 6.2% is paid by your employer. Keep in mind, if you're self-employed, you kind of wear both hats. You're the employer and the employee. So you would be responsible for 12.4% of the payroll tax there. There is an additional Medicare tax as well. So 1.45% on all of your earnings. Again, if you're self-employed, you're responsible for both parts of that. So 2.9%. Those numbers and those percentages have not changed since 2024. This is a question that I get a lot is, well, if I'm already on Social Security, what portion of my benefits are taxable? So this is a different tax question than the two taxes that we talked about before, okay? The first two that I just talked about were for people who are still working and paying into the system. The taxation that I'm going to talk about now is for people who are retired and currently collecting benefits and figuring out whether or not their Social Security benefits are taxable. So this boils down to a couple different parameters. The first and most important is they're going to look at what is your provisional income. Okay. How is provisional income calculated? Well, we look at your tax return and we say, what is your total adjusted gross income? We're going to add back 1/2 of your Social Security benefit, plus any sort of tax exempt interest that you might have. And that equals your provisional income. So that's the first thing that you look at. The second thing you look at is, what is your filing status? Are we married filing joint? Are we single? Are we a qualified widower? Are we married filing separately? That all is a factor in determining whether or not your Social Security benefits are taxed. So I'll use a very common example that we see: a couple married filing joint. If their provisional income, so again, that calculation down there, is under $32,000, which is pretty rare, I would say, then none of your Social Security benefits are subject to tax. But if it's in between 32,000 and 44,000, then up to 50% of your benefits are taxed. And over 44,000, which is what I see most commonly for a married filing joint couple, then up to 85% of your Social Security benefits are taxed. So it depends on your filing status. I will make a note though, they're not very forgiving for those who are married. They're filing separately, but they're still living with their spouse. In that situation, no matter what your provisional income is, they're just going to slap an 85% tax on your Social Security benefits. The other important piece to retirement income planning, aside from Social Security, is something called RMDs. So this stands for Required Minimum Distributions. It is a mandate by the IRS that you start to take a minimum amount out of your pre-tax retirement accounts once you turn a certain age. So everything that's in your IRAs, if you have a 401k, but you're not working there anymore, that also counts towards this calculation. A few years ago, this starting age was 70 and a half, but they have incrementally increased the age for RMDs. And for 2025, it is now 73. So if you're turning 73 in 2025, this is something that you need to consider, because you're basically mandated to take a certain percentage out of your IRA, which is taxable income, and you can put it in any account you want. You can put it in a checking, back into an investment account, but they're forcing you to take it out of this pre-tax bucket so that they can tax you on that distribution. So with that, there needs to come proper planning, because with a lot of retirees, they could be in a higher income tax bracket that they weren't prepared for because of these RMDs pushing them into the next tax bracket, depending on how big those IRAs are. So what are some of the things that we talk to our clients about in preparation for these drawdown years and RMDs as it relates to taxes on your Social Security benefits? Well, we usually start this conversation not when people are close to the age of 73. We're looking at their IRAs. We're looking at the potential investment growth within those accounts, as early as when they're 55 or 60, when they're considering retirement, and potentially forming an income strategy which helps draw down those IRAs before the IRS forces you to take it in the form of RMDs. The other strategy that we've utilized is something called a Roth conversion, where you move your pre-tax IRA dollars into a post-tax Roth IRA. All of the conversions, you're still getting the tax-free growth from a Roth. And when you take distributions from a Roth later on, there's no RMD requirement, and all of that is tax-free. There is some careful planning, though, when we are talking about converting to Roth, because in the year that we convert, we're going to report the amount that you convert as income. So it's important to talk with your planner and to talk with Sarah on figuring out what is a good balance, to figure out an amount that's a good balance to convert to Roth. The last thing is maybe consider delaying Social Security, right? Because the later that you delay Social Security, you reduce the number of years that that income is subject to tax. Of course, everybody's situation is different, and we can't just put an umbrella statement on it and say, just delay Social Security so you don't pay tax. Everyone's situation is different. Definitely check in with your planner to see if that is a viable strategy to help reduce the Social Security benefits, if that's what you're concerned about. All right, we're going to switch gears to Medicare because that kind of goes hand in hand with Social Security. And we'll talk about some Medicare premium increases and also some dates to watch for. For everyone who is currently on Medicare, you know that there is a Part B premium that you have to pay for. Last year, it was $174.70. This year, they bumped it up to $185. Keep in mind that this might not be the only amount that you pay for. This is just a base. A lot of our clients might face something called IRMAA, which is an income-related monthly adjustment based off of what their income is, which could actually make their Part B premium more expensive than the $185. So what is IRMAA? IRMAA is an additional adjustment to your Part B and your Part D, which is your prescription drug coverage. And again, this is all based off of what your income is. So a little bit different than when they look at Social Security taxes. Remember, they look at provisional income. For IRMAA, this is looking at your modified adjusted gross income. So the modified adjusted gross income is calculated a little bit differently. We can help you look at your tax return to determine what that number is. But what is important for you to know is what are those thresholds, right? So you see that it's broken down into a single filer versus a joint filer. We primarily see joint filers and single filers. Those are the two columns that I'll focus on today. But if your modified adjusted gross income is above 106 as a single filer or $212,000 for a joint filer, then, sorry, if it's under that amount, then there's no adjustment to your Part B premium. You just pay the $185. That's it. It gets a little bit tricky when your income is above that, because not only do you pay the $185 for Part B, but they tack on an extra $74 and then an extra $13.70 for your drug charge. So the more income that you have, the more expensive that adjustment is going to be. The other key is this is always a 2-year look back. So whatever your premium charges are for 2025 is based on your 2023 modified adjusted gross income. So we do a lot of pre-planning with our clients, at least to prepare them for any sort of IRMAA adjustment so that they're not shocked if all of a sudden their Part B and Part D is increased and they weren't expecting it. And you can see right there at the highest tier, it could be an adjustment upwards of $700. So it's important to look at this and prepare for this. They do have an appeals process where if you were earning a lot more income in 2023, and then all of a sudden, and then you're retired in 2025 and your income is substantially lower, there is an appeal process that you can go through and we can help you with that. But just know that there are additional adjustments based off of your income for Medicare. So what are some important Medicare dates to watch for? Well, between now and March 31st is the Medicare Advantage disenrollment period. So this is a time for those who are currently on Medicare Advantage to maybe switch back to original Medicare. I don't see a lot of clients doing this, but it does allow you to do it during this time frame. It also is a Medicare general enrollment period. So if for some reason you missed enrolling in Medicare during your enrollment window, you can do that in January, between January and March. The other thing to watch for is open enrollment. So this is important. Like towards the end of the year, you're going to have a chance to review your Medicare Advantage plan and any supplemental plans for the following year. So between October 15th and December 7th, you should absolutely take a look at your current coverage, What are the things that they're changing in your coverage? I see it a lot where people don't review their drugs. And sometimes you switch drug plans and you don't necessarily need certain prescriptions anymore. And then they end up overpaying for their Part D prescription drug plan. So take some time. If you don't have a Medicare broker, if you don't have a professional that you have as a resource to go talk to about this, let us know. We have Medicare specialists that we partner with to help you review your plan, review your drug plan, and make sure that it is fitting with what you're looking to have coverage for in the following year in 2026. So just keep that in mind. December 7th is that cutoff date. And those Medicare specialists get really busy, so don't wait until December 7th. All right, we're going to switch gears a little bit and talk about the future of Social Security. I know that there's been some buzz around what's going to happen. Is Social Security going to run out? Are we going to lose our benefits? Let me give you some numbers and to talk about the trust fund and give you a little bit more perspective. So first of all, Social Security has always been a pay-as-you-go system, right? Because when you're working, you have the payroll tax. And you're paying into this system so that you can collect benefits later on. One of the biggest generations that have been paying into the Social Security system are the boomers. And for the longest time, this pay-as-you-go system was working pretty great, actually. Everything that was being paid in, it gets invested in pretty conservative treasuries, so it's earning something while it's sitting in the Social Security Trust Fund. And when it comes time to pay out those benefits, it's been enough to cover what the benefit claims are. In recent years, because more baby boomers are retiring and starting to claim their benefits, that's when they've had to draw down the trust reserve fund, right? So all of a sudden, the pay-as-you-go isn't enough to cover everyone's outgoing benefits. Now they have to dip into this trust fund. So as of the end of 2022, the OASDI, which is the Social Security Trust Fund, started at $2.8 trillion. In 2023, with the income through payroll taxes and things like that, they collected about $1.35 trillion into the fund, and they paid out about $1.39 trillion. So you'll see that there was a decrease of about $41 billion in 2023. So that leaves the trust fund balance, and these are the most updated numbers that we have, as of 12/31/2023 at $2.7 trillion, sitting in reserves currently. What does this mean for the future of Social Security? So if nothing happens whatsoever, we still have the current workforce. They're still paying into Social Security. Between now and about 2034, they can still afford to pay out 100% of the scheduled benefits out to everyone who's receiving Social Security. But what happens after 2035 when this savings trust fund reserve is depleted? Well, keep in mind, it's a pay-as-you-go system. So we still have people in the workforce paying into Social Security, but it's going to decrease that benefit to about 83% instead of 100%, assuming there is no reform, okay? They've been talking about reforms for a long time, and they've had several ideas go through Congress, and the top four that they've really highlighted in recent years on, well, what can we do to restore some of that solvency so that we don't have to decrease benefits or so that it doesn't run out? The first thing is, remember the earnings max that I talked about, where only the first 176,000 of that is subject to Social Security tax? Well, one idea is, why don't you just increase the maximum earnings that are subject to Social Security tax, right? Maybe instead of 176 this year, or not this year, but in future years, they keep increasing that so that the higher income earners are paying the Social Security tax to then fund that trust reserve. That's one idea. Another idea is, well, why don't we raise that full retirement age? Remember this age 67 that I talked about? Instead of 67, why don't we raise it to 68, 69, or 70? I mean, that begs a pretty good argument because people are actually living longer. And so if you raise that normal retirement age, it will delay when people are wanting to pull Social Security. So it leaves a bigger bucket. With the millions of people who are claiming it, that could be an option. The third option is, well, maybe they decrease what is being paid out to future retirees, right? So they recalculate your Social Security benefit every single year based off of how long you've worked, what your earnings records are, and they use this really sophisticated they use a sophisticated algorithm to calculate all that. What if they just lowered benefits and changed up the calculation a little bit? That could work as well. And lastly, they talked about maybe reducing cost of living adjustments rather than basing it off of CPI, which is the consumer price index and what inflation is. And maybe you lower it so that you're not keeping up with inflation as closely. So there's a lot of different things that they can do to restore the solvency to the system. I don't know if they're going to necessarily do any of it this year. Congress is aware that the funds are supposed to run out at some point, but it's not an overnight shift. And considering they still have funding to pay out 100% of the benefits through 2035, I really don't foresee them taking drastic measures to fix this system at this moment, but they're definitely talking about all these various ideas, and it could be a combination of those things that I just mentioned. So the bottom line is Social Security is not going bankrupt. It's going to be there. A matter of how much the benefits, per claimant, that's going to depend on how much of the reform and, how much they're going to restore to this system. All right, we're going to move on to claiming strategies. So this is for people who are considering Social Security. What are some things that they can be doing to maximize their benefits, especially if they're married, to make sure that both spouses are maximizing on it? So prior to 2016, there was a really, really cool strategy called the file and suspend, where the higher income spouse could file for Social Security so that their spouse could get up to 50% of their higher benefit. And then they can just turn around and suspend it so that the spouse continues to get the benefit, but the higher earner suspends it until age 70 so they can maximize it. They got rid of that. So that's no longer a strategy that can be utilized anymore. For those who are grandfathered into it, that was fine. But moving forward, as of 2017, that's no longer a thing. So just know that. There is a way for a lower earning spouse to still get benefits though. So I see this all the time where we have husband and wife. One of them was the higher income earner. Maybe the other one stayed home and they didn't have as much in Social Security benefits that they could be claiming. Well, they can still claim up to 50% of the higher earner's Social Security benefit. The only caveat is the higher earner has to file, right? They have to file in order for the spouse to get the 50%. So it really boils down to timing. And that is something that we can help at the office to look at your Social Security benefits for both spouses and give you an idea of what the timeline is in order to maximize on your Social Security benefit for the both of you. All right, we're going to lastly cover the WEP, which is the windfall elimination provision, and GPO, which is the government pension offset. This only affects a very small percentage of our clients and the general population. If you were under WEP or GPO, you would know. So basically what happened was there was a lot of teachers, firefighters, federal workers who were working at an employer that did not pay into Social Security. So for those people, their benefits were actually reduced because of the WEP and the GPO. While recently, this administration got rid of that. They repealed it So they basically retroactively paid back benefits to those who were under these two programs. So if you recently saw an increase in your Social Security and you're like, why did I get a heck of a lot more than the COLA? It was probably because you were covered under this provision, which has now been repealed. So Social Security has been issuing a lot of corrections to restore some of those benefits. And that happened as of like February 24th. So just a couple weeks ago. If you have questions, if you are under this provision, let us know. We can help answer any questions, but for the most part, you're getting more in your Social Security benefits, so that's not a bad thing. Lastly, I want to make sure that you know that all of the planners in our office are Social Security experts, and we can help with a Social Security checkup. So if you haven't met with your planner to talk about your claiming strategy or how it fits into your retirement income plan, definitely schedule a meeting and we can walk through that. I also want to highlight that there has been quite a bit of misinformation out there as it relates to Social Security, and there's been scams. So, the most important thing is when you're going and looking at information, make sure that it's a secure website. So ssa.gov, when you click on your browser, ssa.gov is a Social Security, is a secure website that you can get information for both your benefits and also any updates to various pubs and things like that. So that's a great resource. There's something called the POMS. You don't really need to worry about that, but that's what the Social Security Administration workers, that's where they get all the information. Just make sure that you're accessing secure information. With everything that's going on right now, they're talking about firing half the staff in Social Security. That's really going to boil down to us being able to be self-sufficient and getting information in a secure website rather than trying to call Social Security, be on hold for 3 to 4 hours, or worse, show up to the local Social Security office and wait in line for 6+ hours. I've heard of nightmares like that. So let us know if you need help or if you want us to walk you through how to navigate the ssa.gov website. We're here for you. I will open it up for Q&A. I didn't see anything in the chat, but feel free to unmute yourself. If you have a question, I'm going to stop the recording so that we can do some Q&A here.